So our next speaker for this morning is Andrew Headley, who is Head of Global and a Portfolio Manager at Veritas Asset Management. Andrew manages the Nedgroup Investments Global Equity Fund, a concentrated portfolio that's focused on valuation and capital protection during these difficult times, which is certainly, as you can imagine, quite a top priority for investors. Andrew, welcome, and over to you.
Thanks, Anil. I understand we're running a bit behind time, so I'm going to jump straight into it. So I'm going to talk a little bit about the fund and then talk about interest rates and the impact that's having on markets. So quickly on the fund performance, there's a slide that you can see now. The last 12 months has actually been pretty horrible for us, 39% versus 54%. Obviously, that takes it from the nadir of the trough of the equity market. We outperformed in the declines in the first quarter of 2020, but we've underperformed since, and we'll come back to why that is. If we look over longer time horizons, and our aim is to deliver good real returns to clients over 5 years plus in a stable, low volatile way, as you can see, our returns are much better. So it's been really affected by the last 12 months, which we'll come back to. Moving on to the next slide, just quickly in terms of performers, and I don't think we've got time for questions today, but the good performers for us in the last 3 months are shown on the next slide, and there's some negative performers. Really, in the 3-month period, there's not a lot to say. We haven't had any particularly bad results or anything from any of the companies that we invest in, so there's nothing really to worry about. It's just in terms of what we're seeing in the market is a lot of sectoral rotation, which I am going to talk to. We've made a little bit of changes to the portfolio over the quarter. We bought CoStar Group, which is a real estate business, a digital real estate business in the US with a fabulous management team. We bought back into Moody's. We haven't held Moody's probably for 5 years or so. We've held S&P, or maybe 10 years for Moody's. We held S&P about 5 years ago for sort of 3 or 4 years. We really like the ratings agencies, and they sold off last year because they're seen as exposed to a change in debt issuance during 2021. We sold out of Philip Morris and Svenska. Svenska rose with the sort of rising interest rates, people thinking that banks are going to be in a better position with a steeper yield curve. We decided it's probably not high enough quality for us. They changed one of the things we really liked about the company, which is how they remunerate their senior staff. Historically, they've given them a bonus which went into their pension fund, which we've always liked because it encourages long-term thinking in a bank, and they've changed that. And so we engaged with the management team. We told them how much we disliked the change, and they went ahead and did it anyway. So we decided to sell that after a rise, and Philip Morris similarly, the share price rose, and we reached our intrinsic value. In terms of the portfolio as we stand, we've got 29 holdings. We're pretty concentrated. There's a list here. It shows you the top 10. As you can see, looking at the sectoral split on the right-hand side, we're heavily weighted in healthcare, industrials, and communication services. Communication services is a slightly strange catch-all phrase these days. It has cable in there. We have a very big position in Charter, as you can see on the left-hand side. And also things like Google, so Alphabet is included in communication services. IT is only 10%, which is much lower weighting than the market. And actually our IT is again, it's slightly strange because it's MasterCard, which we wouldn't really class as IT, we'd class as financials. It's Fiserv, which is again a fintech business, and it's Microsoft. So Microsoft clearly is IT, but the rest is really not what we would class as IT. Financials is all diversified financials, not banks. And as you can see, cash is 3%. Just running through this because I want to get onto the talk a little bit about interest rates. This is a slide of portfolio positioning. It hasn't changed much. As you know, we're long-term investors. So in general, we hold our positions for at least 5 years. So this doesn't change rapidly. And so you can see how we've categorized some of the holdings that we have. We have a lot in value-based healthcare, which we're very positive on. We have a lot in big data. Aerospace has obviously been very difficult over the last year with little flying, but we think that will come back strongly over the next couple of years. But any questions on any of these things, do let Anil know, and he'll pass any questions on to me, and I can get back to people. So, given time, I wanted to talk about ultra low interest rates and what that really means for future returns, because I'm not sure how widely understood this is. So just quickly, if we look at interest rates, so interest rates shown on this slide, these are the 10-year bond yields since the 1970s. We've been in a 40-year bond bull market. Interest rates in the US peaked at 16%. They fell to almost zero, 10-year Treasury. And that's been the same everywhere. So you can see the trend everywhere has been very similar, bond bull market. And what everybody has to remember with these is that interest rates basically power everything in the economic universe. So everything rests on these interest rates. So everything else is priced based off these interest rates. Now, the original bull market from the 70s and 80s all the way through to sort of the 2000s seemed fairly reasonable because it was based on increasing globalization and increasing technology. And these things are both deflationary. And so as a consequence of that, you would expect bond yields to decline as inflation and structural inflation declines. What we've seen since then has been due to policymakers' moves. Policymakers are suppressing interest rates. And so the way that they're doing that is they buy their own bonds that they issue. So what happens in the US is the US Treasury issues bonds. Last year, they issued, I think, $4.3 trillion of bonds. And then another arm of the government, the Federal Reserve, buys those bonds. So last year, the Federal Reserve bought $3.1 trillion. So basically, the Fed is buying over 70% of the bonds issued by the government. And the consequence of this is that they're price agnostic. In fact, they're probably worse than being price agnostic. They probably actually want a higher price in order to reduce yields. And so they will pay pretty much any price in order to get to the yield that they want. And so this is suppressing yields. Now, when you suppress yields, what happens is that has an impact on every asset price because everything is priced off these yields. And I think what people don't understand in some ways is as you reduce your yield, so as the price increases, you get an upfront benefit in the value of that asset, whatever it is, be it treasuries or equities. But what that also does is it embeds a lower return going forwards. So if, for example, you bought a bond, US Treasury in 1999, and you got a 6% yield and you held it for 10 years, you got 6% a year. Now what's happened has been because the yield has gone from 6% to, say, 2%, if you held a Treasury during that period, the asset value, the price of the Treasury has gone up, so your yield has gone down from 6 to 2, but your future return is now 2, not 6. And so what you've done is you've accelerated, you've brought forward the returns, and the same applies to equities. So what we've done basically with the government have brought forward returns, and what could threaten this? And the answer is on the next page. So what could threaten it is basically an increase in rates is basically inflation. So the way that we could get inflation is through a normalization in policy. So in other words, the Fed stops buying quite as much as it has been of Treasury issuance, or because people start spending more and velocity of money goes up. So this shows on this chart M2 in the US. So this is a measure of money. It's basically money and near money. And as you can see, the growth rate in money is phenomenal. It's 25 to 30%, which we haven't seen before. And this is an experiment by the Fed. So if the velocity of money, so nobody's been spending, velocity of money has gone down. Nobody's been spending because we've all been locked in our houses. But as people go out, it's likely the velocity of money will increase. And there's a well-known equation, MV equals PY. So basically, if velocity goes up and money supply goes up, then either GDP goes up or inflation go up or both. And so it's likely that we would see inflation rise. Just on the next slide, what I've done is just tried to illustrate the impact of rates and low rates on asset prices. And I've got a few slides on this so people can see it. So this is the S&P versus the Fed balance sheet. So basically, as the Fed buys, and we were talking about last year, they bought 3.1 trillion of treasuries and T-bills. As the Fed buys, asset prices rise. And you can see that pretty clearly here because interest rates go down as they buy. And you can see this is linked very closely to the S&P 500. I can run through just very quickly some other valuation metrics that we've seen. So this is really just an example of saying that that what we've done is we've brought forward the asset appreciation, but from here, once you've got to these high asset values, your expected return going forwards must be lower. So here on the left-hand side, we've got the S&P 500 price to sales ratio. As you can see, it's never been higher. We're now at about 2.8 times on price to sales for the S&P 500. On the right-hand side, we've got a measure of a smoothed earnings valuation called the cyclically adjusted PE, which takes a 10-year earnings. And as you can see, we're at 34 at the moment. It was surpassed in 2000. So this isn't the actual peak, but it's the second highest, so higher than we had in sort of the 20s. And it could go higher, but what we're saying is we've brought forward returns. And then we can look at some areas that have specifically benefited. So what happens is that there's what's called a bubble triangle. And to have a bubble, basically what people think is that you require three things. So you require credit or money, so credit and debt. You require marketability, so you need things being brought to market and an easy way to purchase, and you need speculation. Well, obviously, we've got a huge amount of credit and money around. We think marketability has increased as well in the last 12 months, or maybe 2-3 years, because we've got things like Robinhood, we've got easy, no-cost trading, we've got SPACs, we've got cryptocurrencies, we've got all of these things that are easy to trade. And we think now we've also got the third part of this, which is speculation. So we have all three sides of the bubble triangle in place. And as you can see, some areas do better. So speculative areas do better in that sort of environment. And this chart here just shows how well technology did in total during 2020. But in particular, if you look at the bottom line here, unprofitable technology. So in 2020, on a market cap weighted basis, unprofitable technology companies over the whole year, so this includes the COVID declines, were up 92%. This is in the US again. It's just incredible. So this is a highly speculative, loss-making companies that basically almost doubled during 2020. It's also shown on this chart here, which is a Goldman Sachs chart. So what they've done is they've basically made an index of non-profitable technology companies in the US, and as you can see, this is pretty parabolic. So this is where the money is going today. This is very highly speculative. There's a lot of margin debt out there. There's a huge amount of credit out there and money, and we're seeing it go into what we would see as speculative investments and driving these things very high. I've just got a couple of other quick examples to show where the money is going. Bitcoin on the left-hand side. I have no real view on cryptocurrency. It seems pretty speculative. You've probably all seen the currency, I think it's called Dogecoin, that was set up as a parody of Bitcoin, is now worth $52 billion as a parody. We've got SPACs, so these are special purpose acquisition vehicles, which certainly increase marketability. And as you can see on the chart on the top right, we've had a huge amount of transactions in SPACs. So again, we think this is very symptomatic of a speculative market. We've got a huge amount of unprofitable technology companies, as you can see on the bottom left, and the bottom right is a very well-known index. It's the semiconductors index. So this is huge companies. So things like ASML, TSMC, all the big tech companies, semiconductor companies, and their outperformance since COVID has been phenomenal, as you can see from this chart. So what we can say from this is we think if you look at the bubble triangle, we are now in a period where we're seeing the impact of interest rates and the huge amount of money and credit available running into a speculative period. And it's certainly coming through in some of these assets. Now, as I said at the start, what we do is we invest in high quality companies that are low volatility. And actually what we've done on the next chart is we've just tried to show what's happened to low volatility companies versus high beta companies. So high beta companies would traditionally be seen as high risk companies. Now these are all companies in the S&P 500. So they're all, these are not speculative, unprofitable technology companies in the high beta index. These are all profitable companies that are part of the S&P's largest market cap companies. But as you can see, if you look at the light green line, so these are the sorts of things that we would invest in. So low volatility, generally they're things like healthcare, consumer staples, basically companies that compound earnings over very long periods of time. They outperformed in the first quarter of 2020, as we did. And since then, they kind of recovered a little bit, and then they've been flat. If you then look at the dark green line, this is the high beta index. So these are the high risk companies. Again, these are profitable companies. They underperformed significantly during the COVID declines. But then because of this decline in interest rates, the speculative excess, what we've seen has been that these companies have hugely outperformed. So they're up around 50%, 55% in fact, from the start of 2020, whereas the low volatility index is flat. So there's 55% outperformance of these companies in the last 12 months. Now, what does that mean for us, and what does that mean going forward? So this is my last chart. You may be pleased to hear. I know Anil will be. So this basically shows the same index as the one I just showed, but going back to 1999 to 2002. The dark green line is the high beta index again. And as you can see, the dark green line outperformed markedly in the rise to the peak in early 2000. So at one point, the high beta index over that period was up around 80%. And at the same time, the low volatility index, which is the light green line, was down 20%. So there's a huge difference here. But of course, when the speculation stops, the low volatility index tends to do very well. And over the long term, the low volatility index outperforms. And what we can see here is the low volatility index hugely outperformed post the declines in 2000. So from this 80 in early 2000, the low volatility index was up, ended around 100, whereas the high beta index fell from about 180 to 60. So there's a massive decline. And whilst history doesn't repeat, we do think it rhymes, and we think we are in a period right now of this excess speculation in certain asset classes, where the future return has been brought forward and perhaps even overdone. And so we would expect some of it to be given back certainly over the next 5 years. So with that, I know I'm kind of out of time. So Anil, I'm going to hand back to you. I don't know if there's questions today or if we save those for another day.
Thanks, Andy. That was actually very comprehensive. I guess the one thing just to correct you on that I am pleased about is that you're my global equity manager. So thanks for that. We'll take one question from the audience today, and it actually relates to, especially given some of the high valuations that you've shown in some of the charts in your presentation pack. So do you think now's a good time to phase into global equity markets? And especially, I think, given that you flex your cash balance quite opportunistically, you might be the right person to answer this. And if you do think so, over what period do you think would be appropriate?
Yeah, so I think we're actually at a phase in the market at the moment that is quite dangerous in certain aspects. But having said that, sorry, what I mean by that really is that there are a lot of companies that, as you've seen, are loss-making, coming to market. We're seeing SPACs, we're seeing a huge amount of speculative behavior. And we think that actually what that's doing is people are ignoring these companies that are long-term compounders. Now, if there is a market decline, and a market decline is likely to arise because of a fear of inflation coming through and people worrying that the policymakers like the Fed are behind the curve. So if this fear of inflation comes through, we get bond yields rising further than they have already. That would have an impact on, as I say, all asset prices. Now, in that environment, and we can certainly envisage that, then those high-risk companies would fall substantially. I think that the sort of low volatility companies we own would hold up very well, but valuations across the board are quite high, Anil. So we always recommend to people that what they should do is basically invest over a long period of time, so that you basically wait your entry into the market. There are times when markets fall substantially, like March last year, where you can put a huge amount of money to work, as we did during that decline. But actually, I wouldn't say that now is a particularly great time to invest everything. But if I was, as I do, so with my money, I invest on a kind of continual basis. So I'm constantly putting money into the market so that I average out over the period. And that's what I think is the right thing to do now. I think Howard Marks puts it best, where he says proceed but with caution. Okay, because asset values and interest rates are very low, asset values are high, but it can persist for a long time. So I don't think people should stay out of the market. So I think you do proceed, but I think you proceed with caution.
Thanks, Andy. That was a very good answer. I do agree with you. Thanks very much for your time. Until we see you again. And good luck.
Thanks, Anil. Thank you.
Take care.